thank you, Dean Thomas and Bob Steers. You guys have really been amazing in the course of this past year, and the excitement is very palpable on campus. And I can say from the standpoint of in the classroom and the students being very excited, this is a very positive movement and something that's been a long time in the making that's had a lot of support. So without further ado, I'd like to introduce our first panel to discuss the state of debt capital markets in the commercial real estate industry. Our moderator today is Bob O'Brien, who's the leader of the U.S. Real Estate Services practices at Deloitte. He has been with Deloitte for 28 years, serving in various public accounting and transactional types of roles for both publicly and privately held clients in various industries with a focus on real estate and hospitality. He will be joined today by Toby Cobb, who is the co-CEO of LNR Property, which is the largest special servicer in the U.S. of assets in the that are trading in the secondary market. And LNR is special servicer for more than $230 billion of distressed assets globally and $2 billion of hard real estate assets here in the U.S. And also happy and pleased to announce that Toby is newly a Georgetown and Hoya dad. So pleased to have him here to welcome that. And finally, Steve Plavin is the CEO of Capital Trust, which is a NYSE traded commercial mortgage REIT, which is one of the preeminent investors in structured capital and finance with regard to real estate B notes and mezzanine pieces. Capital Trust since 1997 has invested more than $11 billion and currently has $4 billion under management in this space. So without further ado, please, gentlemen, come and lend your perspective on the state of the debt markets. Thank you.
Well, good afternoon, everyone. I'm Bob O'Brien. As Brian so eloquently said, I lead the real estate practice at Deloitte, and Georgetown has been an important school for Deloitte. We've recruited a lot of talent out of here over the years. I don't have a kid at Georgetown or coming to Georgetown. I have a daughter at Villanova, and so I may have been written out of my family for being here today, but it's good to be here nonetheless. Brian did a great job introducing Steve and Toby, but why don't, just to build on that a little bit, why don't you guys tell the crowd what you're spending your days doing these days? Steve?
Well, just to give you a little bit more background on Capital Trust, we are a public mortgage REIT and an investment manager. And the investment activity of the firm has really been focused around subordinate debt, so higher risk loans and securities. We buy those investments in the secondary market. We also directly originate loans. The focus over the last year or two has really been in the distressed market. So we've been active buying distressed loans and distressed securities for a fund that we manage called CT Opportunity Partners. We too are also a special servicer, not of the same scale as LNR, but we have a particular focus in working on large, complex, structured loans. And we spend a lot of our time now working on the loans that originated in 1997, which for the most part, 2007, which are coming due now, sort of the 5-year peak of the market loans. And there's a lot of high-profile transactions that we're working on and being worked on with multiple groups, multiple capital sources from around the world. And we tend to be in the middle of them trying to figure out the consensual solution if we can. So the workouts for us are where we spend a lot of our time today, and also, again, trying to invest in the distressed space.
So LNR actually was born of Lennar Homes, the home builder. It was the commercial property division that became the development division for Lennar Homes as a community development company. They would buy a large tract of land and they would build out maybe a strip center, grocery-anchored strip center in one corner and a suburban office building in another, and maybe an apartment building or two on the back corner, a logistics center perhaps. As LNR, the division within the home builder, grew, it kind of grew into the first round of distress in frankly our lifetimes, which was the Resolution Trust era. Having an experienced team that built from the ground up these kind of 5, 7, 10, $15 million assets in multiple asset classes was somewhat unique, right? Usually a company would have a single class of asset that they're an expert in, like retail or office. And L&R within Lennar Homes was building these multiple different kinds of asset classes, enabled them to have what they thought was a differentiated capability to go acquire distressed commercial real estate debt from the banks during the RTC era. That division grew to be, frankly, larger than the home builder, and was spun off as an independent publicly traded company in 1997. By 2005, the company was a multi-billion-dollar enterprise, and it was taken private in a management-led LBO. And the company was then recapitalized in the summer of 2010, which is when I joined the company. Throughout the 2000s, it was the largest acquirer of subordinate real estate risk via the acquisition of the most subordinate tranche in the commercial mortgage-backed security space. So CMBS reached a peak of about $270 billion of financing in 2007 and became the financing of choice for about 40% of all the loans that were financed in the United States. And L&R was the acquirer of that subordinate component that allowed it to get high returns during the good times. And then when things turned around and there were sufficient losses to cause losses to that investment, the assignment to do all the work out for the entire class or the entire pool of collateral came to the most subordinate holder, right? In the case, it was ourselves. So we became, by virtue of the acquisition of those subordinate interests, the largest special servicer in the commercial real estate space. Special servicer is another word for workout guy. So the $240 billion is the big number. That's the number of all the loans that we monitor, right? And the sad news is that of that 240, about $40 billion are in special servicing. So those are the loans that today require special care. And in many, many instances, the value of the underlying real estate is insufficient to pay back the outstanding debt, right? And it's our job to try and get as much as we possibly can, as soon as we possibly can. So that's the principal activities in our shop today, but we still do have a very large principal ownership and vertical development. We manage about $2 billion of fee that we have built ground up in similar asset classes like which we have done in the past.
Well, it's going to be interesting to delve into how you guys are responding to the distress in the market today and how you're resolving issues of distress. And I'm sure there are a lot of lessons learned. But maybe first to just level set. Toby, why don't you talk about the current credit market fundamentals and the market for new issuances today for debt?
Well, we started a lending platform as a subsidiary of L&R. It's called Archetype Mortgage Capital, and so we are participating both on the new origination side, conduit lending, the origination for the purpose of securitization. We've originated about $300 million in the last 8 calendar months, and we have done one securitization, and we have several coming. So we've done a round trip on one full set of collateral. So we have a pretty good view about what's happening on the loan origination side by virtue of our origination team, right? And we've also continued to acquire new issue CMBS subordinates, right? And it is absolutely the case that the CMBS market is growing very, very rapidly again. And I think, frankly, credit standards are slipping again very, very rapidly.
Well, there was kind of a big hiccup there late last summer, right?
Sure.
That lasted through the fall. So recovery from that?
Absolutely. I mean, if you look at where spreads were in commercial mortgage-backed securities at the time, we have actually gone back to where spreads were at that time. And frankly, spreads isn't necessarily concerning in and of itself because CMBS, by virtue of its size, is not really going to be the leading indicator of credit spreads. It follows corporates, and price is usually in correlation to corporates. And it is viewed as whether or not it is rich or cheap with respect to a corporate credit spread. So the spread for everybody's benefit that is not familiar with that, is the risk premium to treasuries. So credit spreads are always talked about as a risk premium to treasuries. But what I'm suggesting is that the credit spread for corporates is really a much bigger and deeper market than CMBS, and so CMBS usually trades as a credit spread to corporates versus thinking about it really as a credit spread to treasuries.
I mean,
Things have definitely gotten tighter, but what I'm maybe more concerned about is the loosening of credit standards, right? And while clearly the loosening of credit standards is good for commercial real estate valuations, right? So I think we're seeing
in transaction activity.
and transaction activity. So I mean, those are healthy, right? But we'd rather see broader availability with more stringent credit standards for a stable, long-term, healthy commercial real estate market versus weak credit standards cause bubbles, right? And so we certainly hope that we're not going to see bubbles form by weak credit standards in the go-forward environment.
Steve, are you seeing the same loosening of credit standards? And
Well, I think there's the inevitable creep as the market evolves. You know, the best deals to buy are always the ones that come first, because they're the ones that are most conservative. So the first deals that were done in 2009 when the market reemerged were the best from an investment standpoint. And the deals started to get pushed until the S&P crisis last summer. And the interesting thing is that the market is functioning at a small fraction of where it used to be. Bear and Lehman and Credit Suisse and Merrill are all gone, and they were all very significant originators at the peak of the market. The market this year is going to be somewhere in the range of, $30 billion?
Maybe.
Again, a small fraction of where it used to be.
I think 06 was like 240 billion, something in that range.
So you'd think that given that dynamic, that the power would have shifted to the lenders, that the borrowers would be suffering from a shortage of capacity in the market, but that hasn't really been the case. There's plenty of capacity in the market, and the forces of competition is what's pushing the credit standards. And the lenders who are still active in the CMBS market are pushing very hard for product, and they're reaching. And Toby's right. I mean, we're seeing deals on the margin getting done that probably shouldn't, and the incremental dollar that getting loaned that again probably shouldn't. And the CMBS market typically is the one whose credit standards go first, because if you're a credit officer in a CMBS shop, and somebody says to you, well, I promise this loan will be sold to someone else in 120 days. Whereas if you're in a bank or an insurance company and the intention is to hold the loan to maturity, it's a different credit decision and a different course of conduct. So as a result, the CMBS market ebbs and flows much more than the traditional lending markets do. And I think that Moody's came out this week and said that if the trend continues, that they're going to change subordination levels and structure the deals more conservatively to try and reverse some of the creep that we're seeing in the deals. So it's an interesting phenomenon, and you'd think with rates low and values increasing, there would be a lot more demand for money relative to supply, but that isn't the case right now.
Different studies show something in the neighborhood of $1.4 trillion in commercial real estate debt coming due in the next 4 or 5 years, right? And, say 300 or 400 billion a year. You mentioned CMBS market at around 30 billion a year. How does that
extend and pretend, right? For those of
so
you who
continue to kick the can down the road.
For those of you who haven't heard the term, believe it, it's real. We had a massive amount of loans that were supposed to come due in calendar 2012 that have already been extended. The propensity of banks, life companies, and the CMBS universe to put off the pain and extend has been very, very real. And frankly, until there is some regulatory discipline around the mark on those assets, I don't see that changing. The vast majority of commercial real estate debt is still held on the bank's balance sheet, right? Mm-hmm. So still 65% of all the lending in America is done by banks, right? And the banks have been extending.
Do you include yourself as a bank when you talk about banks in that context?
We absolutely have been using extensions and modifications as a form of resolution. We were talking a little bit, L&R represents 38% of all the loans in special servicing. That said, we only represented about 11% of all the loan modifications or extensions, right? So we're batting well under our weight when it comes to extensions as a form of resolution. But there are 4 or 5 different kinds of resolutions that, that we do to try and make sure that we get the most back as fast as we possibly can. So in resolution land, the first and usually the harshest is foreclosure and taking the asset REO and then selling the asset, right? There's also a note sale, which is just take the loan and auction it off to the highest bidder, right? Then there's maybe a modification that includes a recapitalization. So you tell a borrower, look, we'll allow you to extend, but we're going to require principal pay down. We're going to require new capital to the asset, new reserves. So in many sense, we call that a recap. Could be a loan that's, that just can't quite get refied because it's 90% loan to value, and you're going to say, okay, well, if you give us a 10% pay down, we'll extend that loan for you, and that's certainly happening in the CMBS space. And then in some instances, there's just kind of payoffs where the borrower represents the most attractive way to resolve the asset for the investor, whether it's your loan or a loan where you're representing a trust or a life company. And in those cases, sometimes borrowers have motivations that the standard investing public might not have. So, for example, a borrower might have a tax basis in an asset, right? And their tax basis in that asset might make them lead to make a decision to recapitalize or buy a loan at substantially above what its value is because they will avoid a recapture on debt forgiveness. And so in America, if you get a debt forgiven, that's actually income, and that's income on which you have to pay taxes. And I'm telling the accountant that.
Yeah,
for the benefit.
you always have the IRS as a partner in every deal.
Right, right. So believe it or not, if you can't pay back your debt and you don't make good on the debt, it's income to you. And so borrowers tend to behave a little bit differently, and a lot of times we can get a better deal out of a borrower. We look at it as our job in the special servicing space to try and get as much as we possibly can back for the benefit of the investor and as close to the maturity date as possible. The way I look at it, the very best thing that can happen in debt is that the borrower behaves consistent with their contract that they signed on day one, right? So a borrower usually signs a contract and it says that we're going to borrow this money and we're going to pay it back on the maturity date at par, right? So they say we're going to borrow 100 and then on the 10th anniversary we're going to pay back the then outstanding balance at par. There's no way to get back 110 in the debt land, right? There's no upside, right? So the very best thing that can happen is what you prescribed to happen in the first place. And as the special servicer, we look at it as our responsibility to try to get as close to the contract as we possibly can.
Mm-hmm. Steve, what are you seeing in terms of, as you invest in distress and try to work out distress, what are you seeing from a deal standpoint? How's it changed over the last couple of years?
Well, just my thoughts on the extend and pretend. I mean, I agree with the extend, but I don't necessarily agree in many cases with the pretend. I mean, a strategy of forcing capital events to try and repay loans at the bottom of the cycle didn't make any sense. So for loans to be extended in 2009, 10, and maybe the first part of 2011 was the right decision. It maximized recoveries to the mortgage holders. It enabled the owners of the properties to justify putting some money in a recap and having a chance of having value restored to their position. And there's still a lot of extension activity, and some of it is for the wrong reason, but a lot of the extensions that we work on, as long as you require someone to take responsibility for ownership and put capital in and be at risk, then extension's often the right course of action in a market where fundamentals are improving. As it relates to what we're seeing today, and the difference in the deals now versus the deals that I worked out in the last cycle when I was at Chase, is that they're structurally much more complex. The loans are divided horizontally. So that what that means is that there's a first mortgage that might be securitized and put into a CMBS trust. And then there's a junior interest in the mortgage that's sold to investors like us that are held outside the trust, but are still part of the mortgage. So you're still a participant in the same loan that's now partly securitized and partly not securitized. Then there are additional lenders, mezzanine lenders. And a mezzanine loan is like a home equity loan. It's a loan against the equity in a mortgaged asset. And you might have 2 or 3 or 4 mezzanine lenders, and they might not be participants in the same loan. They each might have their own loan, one more junior than the next. So you have a mortgage loan with 2 participants, you have 2 or 3 mezzanine loans, you might even have a preferred equity provider, and then you have an owner. And a lot of the resolutions require consensus among this sort of disparate group of participants in this financing who are at something. The senior guy might be in the money and say, hey, I want to foreclose, or I want to sell the loan, or I want to do something now. And the junior guy might be either out of the money or hanging on saying, I want to extend for as long as possible to give myself a chance to recover.
That's something we affectionately call tranche warfare. So the tranche that is the most junior is at war with the tranche that is the most senior because they're not aligned.
They're facing different risks.
Right.
Yeah, and it's further complicated when you have deals where the original holders of those positions are in, and they paid par for them and provided the original capital back, say in 2006 or 2007, and you have a couple of people who decided at some point in time to sell to a predator or a more opportunistic investor, and so you might have somebody else who's in at 20 cents on the dollar. And so you might have 2 people in the same tranche of the capital structure, one who's in at 100 cents and another who's in at 20 cents. And as soon as he can get 30 cents or 40 cents, he's the seller. And the guy who's in at par is, I want to extend, I want to try and extract something else from the borrower. So the deals are much more complicated. And one of the themes, as Toby kind of indicated with tranche warfare, is that the complexity in these deals really equates to risk, that the complex deals are riskier just by virtue of their complexity than the simple deals. We spend a lot of time trying to navigate the complex deals.
So given all that, wouldn't I rather borrow money from a bank? How are banks resolving their troubled loans on their balance sheets?
The reality is that borrowers, time and time again, will go to where they believe that they are getting the most proceeds at the lowest rate. Right? And
So if I can get 25 basis points lower, I'm coming to
commercial
you.
mortgage-backed securities and structured finance continues to deliver a cost of funds to borrowers that cannot be beaten by a bank. So we just had earnings announced by a huge swath of our financial institutions in America today. The vast majority of the net interest margin, or the NIM, in the banks today is right around 3 to 3.5%, or 300 and 350 basis points, right? So that means you got to make a loan, right, and get a 3.5% margin on that loan, and CMBS is funding the full capital stack at today 200 over, right? So it's hard for a bank to compete with.
Isn't your money more expensive than bank money today, though?
No.
Well,
I mean,
one of the differences is
for 10-year money, right? Floater, a LIBOR floater, which has risks. There's a fundamental mismatch in a LIBOR-based loan than with a piece of commercial real estate. Commercial real estate cash flows are very long, right? Fundamentally, you'd like to match that with long-dated financing, right? Banks
And lock in an interest rate?
Yeah, traditionally banks are LIBOR-based lenders, and traditionally they're 3 to 5 year lenders. Mm-hmm. So if you're a real estate owner and you want to put a 10-year fixed rate loan on, you might not have an option other than the life company or CMBS.
When you borrow money from a bank, the banks will a lot of times know you. You'll have other relationship with the bank, and the banks oftentimes will look for or require a personal guarantee of the loan. And that might be the trade-off for a slightly lower rate. Mm-hmm. The CMBS market, you're hard-pressed to even find out when you read a prospectus or any of the rating agency materials who even owns the property. So it's
all about the property.
It's a borrowing strategy, and people pretend that sponsorship matters, but it's a market that doesn't function at all based upon sponsorship, which is and when you typically make a loan, who your borrower or sponsor is and how they behaved previously and how they're likely to do in terms of delivering the expertise that's required to manage the property, that is just absent from the CMBS system.
Okay, you guys make it sound like we're heading down the same path we went down in 2007. What has changed? Is there truly a CMBS 2.0 or 2.1 or whatever this next version is? Are there lessons learned from the last downturn?
You know, I frankly would argue that the risk transfer model that is consistent with commercial mortgage-backed securities does not work. And so I am very fearful that we are headed down the same path, certainly in the structured finance space. There is Dodd-Frank that's looming out there, right? Dodd-Frank, the provisions of Dodd-Frank have what's called a retention requirement in them, right? One of the reasons why we in the commercial real estate space show our face here in Washington is to figure out what's happening on Dodd-Frank. The Real Estate Roundtable was here yesterday. The Commercial Mortgage Securities Association, you know, active participants trying to figure out just exactly how Dodd-Frank's going to come out on retention, which is the most important kind of outcome for many in the space. Retention it simply means, are you going to hold a piece of the risk for the term of the loan that you make? Right? I personally, and you know, my group, my partners, we all believe that retention is a very healthy thing, and so we would be in favor of retention, both in the CMBS world and in bank world. Right? The lenders that have the best track record throughout the last crisis, life companies, had fully 1/10 the default characteristics of CMBS.
Yeah, they've been running
right?
1% or less, I think, in
DUS,
terms
which
of
is
default.
DUS, which is designated underwriting status. That's actually the multifamily lending that the agencies do,
Yep.
right? That Fannie Mae does. DUS lending has a less than 1% default characteristic versus 13.5% of the loans in CMBS that are in special servicing today. So 1% versus 13% on, you know, similar size asset pool. DUS, you have to hold fully 1/3 of the risk, right? And so I believe that while a blunt tool, fundamentally risk retention is a good thing. And so I think that Dodd-Frank could have some very material impact on credit standards. It's not implemented yet, and it's actually not scheduled to be implemented for 2 years.
Only a couple thousand regulations that have to be developed under Dodd-Frank, so yeah, it might
I-
take a little bit.
I'm no
but-
big fan of the whole regulatory environment and of Dodd-Frank in general, but you know, even a blind squirrel. So the retention component, I think, works.
You know, the challenge with that model is that generally the skills involved in being a portfolio lender are different than those involved in taking on risk and securitizing it and distributing it to the market. So it really caused a fundamental change to the market. I do think that we're very likely we'll end up in, I don't know if we'll end up in the same spot we ended up in with 2008 and 9, but you know, the market's going to continue to be cyclical, and as the forces of competition will put pressure on loans and transactions, and things will inevitably cycle up and cycle down. And you know, it's very hard as a lender to have the foresight to know when to put the brakes on and to avoid sort of giving back the profits that you made in most of the market in the down cycle. And you know, I think Toby's right that the market unchecked will repeat itself to some degree. Not sure that risk retention is the answer, and I think that we need, you know, more discipline in the system, and there may be no other way to incorporate that discipline other than through risk retention. But you know, I think you'll see CMBS volume, at least initially, go way down if that happens.
Yeah, I give a shout out to NAREIT, an event I was at about a month ago where I think it was Jeff Fisher presented an analysis that showed how little net operating income from properties had really declined during the downturn. That this downturn in commercial real estate was all about capital and availability of capital and uncertainty with respect to the capital markets.
You know, I have been a big skeptic about fundamentals for some time. That said, so one of the roles that we have in special servicing space that's actually somewhat unique to LNR, and when we acquired the subordinate interest in the CMBS deals, we wrote into the contracts that we would have the right to approve leases at the asset in excess of 10% of the gross leasable area, right? That's usually kind of a standard provision in a bank loan or in a life company loan. And we negotiated that into our rights as a special servicer. And so therefore, on that $240 billion of loans, We are the agent who approves leases in excess of 10% on all of those assets, right? $300 billion worth of assets. And so it gives us a fairly unique view on a very, very large sample size about what's happening in leasing, right? And I will tell you that 2012, for the first time, there is some real reason for optimism around leasing, right? Leasing is generally a lagging economic indicator, right? Usually you'll make 3 analysts share a cubicle or office and 2 VPs, before you'll bite the bullet and take on additional office space. So, it is certainly from our view, from the commercial real estate sector space, and our view from our, $240 billion that we're seeing for the first time some real reasons to be positive around leasing activity.
Beyond apartment leasing.
Yeah, beyond
Beyond apartment leasing, which has looked actually pretty good for the last
I
couple of years.
I didn't see those statistics, but I can tell you that in the properties that are in our portfolio, especially hotels, but across all property sectors, and there was really significant decline in net cash flow. It wasn't just a capital issue. I mean, it was a demand issue, a very, very significant demand issue. Some of the properties were less impacted because, retail and office in some markets have, 10 and 15-year leases, and if your lease didn't roll in a bad time, your cash flow may not have declined, but, in apartments and condominiums and hotels where the impact is more immediate, there was serious declines in cash flow.
Particularly hotels.
There still really is, though, a haves and have-nots. So what I call the NFL cities, the NFL market cities, are enjoying growth in occupancy and rent, but their secondary and tertiary markets are not growing anywhere near as fast. And so both capital and rents are being attracted to those markets, and the secondary and tertiary markets are not. Frankly, it's one of the challenges that we have in the banks. During the RTC era, during the 2006-07 era, when we were doing $250 billion a year in CMBS originations, you could originate a loan that had 80% of the capital structure financed in CMBS at the riskless rate plus 125 basis points, right? No bank in the world could fund that loan profitably, right? And so, and yet banks' exposure to commercial real estate grew at a 15% compounded annual rate from 2005 to 2008. Why? How could you grow if there's a lender out there that's disenfranchising you? Well, they did construction, and they did land, and they did non-occupied assets because those were the assets. And so that asset is a very different asset than, frankly, the vast majority of the assets that Steve and I are talking about. Steve and I in structured finance, well, clearly there was some bad underwriting. Clearly there was pro forma rents put in place. Clearly there was underwriting that said, I know that the building only generates 100 of cash flow today, but we think it's going to have 120, and that's what we'll write, in the offering circular. That happened in CMBS for sure, but all of the assets, with very limited exception, had cash flow. Right? In the bank land, that's not the case at all. Construction loans and mini perms were, prolific in the banks, and those assets have a very, very different profile and a different problem today.
Well, with real estate fundamentals beginning to improve, and maybe a little more clarity, right, around what direction they're headed, and transaction activity is picking up again. One thing we wanted to talk about was L&R and Auction.com, and was it $5 billion in distress you brought to market in some way, shape, or form?
Well, when people ask me, what's interesting or cool or fun about what's happening in your company, I'd say that everybody wants to own a little piece of something internet related, and so we do. The thing that we have is we are half owners of a platform called Auction.com Commercial. It's the largest liquidator of commercial real estate debt and equity via the internet.
Commercial and residential?
Auction.com is a residential and commercial company in its entirety. We just own half of the commercial component, right? So they are also the largest liquidator of residential assets via the internet auction format. And so our partners are steeped in the internet auction process, and they're Silicon Valley folk. I think the thing that is really cool about the auction format is It is one of those arrows in the quiver that we're using for resolution. So I talked earlier about discounted payoffs or note sales or a recapitalization. Via note sale, one of the ways that we have been selling, and as much as $5 billion last year, was this internet auction format or auction.com. We've learned that the internet process is very empowering to a set of buyers that really, frankly, didn't participate in the commercial real estate acquisition process historically. It is definitely concentrated in assets that are kind of $5 million and down, right? But I call them Sally at Gmail or Mike at Yahoo, showed up and acquired about 40% of the assets under $5 million that we auctioned in calendar 2011. That's a new, unique buyer to commercial real estate. If we are really drawing in a new and unique buyer to commercial real estate, we've changed the supply-demand dynamic for capital in the commercial real estate space. That's a very, very powerful, powerful tool. The auction format allows us to extraordinarily reduce the friction costs associated with resolutions. So one of the things that happens when you try to resolve an asset is you got lots of evil lawyers lurking around in the corners, right? And there are fees for the foreclosure process, and there are fees for the bankruptcy, and then there are fees for them. There's lawyer fees all over the place. And when you auction an asset by the internet process, you have one contract. The buyer has to read the contract, and he has to agree that he's going to sign that contract with no negotiation. So it's very, very powerful for liquidating assets. And I think the last thing is that there is certainly some level of a belief from these participants that they're on equal footing. When it's an open outcry process, it doesn't matter if you are the largest office owner in the land or the largest retail owner in the land, and you're bidding against Mike at Yahoo. You're both watching the screen. You're both seeing who bid last and what the dollar price is to win. And there's no backroom deal with anybody that says, if you just get to 92 cents on the dollar, it's yours. None of it, right? The last click wins, and that's a very empowering process. And I think that's what's drawing in these new, unique buyers.
How do you get comfortable that Mike at Yahoo is going to close? He has the capital.
Mike's been pre-cleared.
Okay.
Yeah, Mike's been pre-cleared for capital, and he's also put up a 10% hard deposit. So if he's the winning bidder, he would have to walk away from his deposit, and there's no contract negotiation, so I don't have to worry about whether or not we're going to come to loggerheads over prorations.
Right.
Very, very cool part of I've said that maybe someday Auction.com commercial will be worth 5, 8, 10 times our whole company, and I'll get to retire and buy a big boat and be able to afford the Georgetown education.
Yeah, that's where it's all going.
Hey, Toby, how do you, is there any conflict in terms of, and I think there's plenty of conflicts in the special servicing business because we're in it as well, but when you think about choosing a disposition path in it for a trust that involves a fee coming to you,
Yep.
and then also, have you seen any resistance from the other special servicers from using auction.com? I now know that you own it and the fees are coming
It's
to you.
going to buy you a big boat.
Yeah. Well, clearly there are conflicts. There are any number of conflicts. There's this tranche warfare issue that we were talking about earlier, where if you are the principal owner of a subordinate class, you might behave differently. There's in CMBS, there's also this concern that you're having an affiliate or affiliate transaction, right? So what Steve is referring to is because we have an ownership stake in auction.com, it might be that one of our loan asset managers has a proclivity to send an asset to the note sale via auction.com as the resolution process more often than maybe would ordinarily be the case, because he knows that the firm more broadly is going to participate in the revenue stream associated with that asset if that's the disposition strategy, right? We put some things in place to try to alleviate that. One, we don't allow our asset managers to know whether or not the resolution strategy is an asset that we own, right? So they make the decision on whether or not they're going to send that asset to a resolution by an auction or to resolution by a modification or a standard note sale via a broker whether or not we have an economic interest in the asset or not, right? The other thing is that there is actually a formula, and the formula does have a level of fixed nature to it. There, you do a net present value calculation of the future cash flows around the resolution strategy, right? And Steve obviously knows this, right? I'm doing this for everybody's benefit. That resolution strategy has to prove out on a net present value basis, right? So there are inputs, right? You say how much of the friction cost is going to be, how much time is it going to take, and what is the probable outcome. Right, what I can tell you is that we, all of us in the special servicing industry, have an obligation to establish something called the fair value, right? And the fair value is the value at which we, as the special servicer, determine that the liquidation of the asset makes sense, right? That's a good enough workout, that's not a good enough workout, right? If you sold that asset for 90, right, that's good. If you only get 85, you shouldn't sell it, right? If you can sell it for 91 on the internet process, right, maybe that's better than selling it for 95 after you've been through foreclosure and sold the REO, because to get through foreclosure, it takes time and it also takes money. It takes those evil lawyer fees, right? So all of those inputs go into the calculation of the net present value to determine whether or not you're getting more back faster for the benefit of the trust. And all of us have to use those. I guess from our perspective, we felt like we are at a very unique spot in the industry today, right? We're kind of at the node. The special servicer is the master of the universe, if you will, because we're responsible for liquidating now $40 billion of assets on our time. That's what we do today, and the responsibility of that really speaks to our franchise, right? And it speaks to what the value of our company is. And if we continue to get more back faster, which frankly most of the independent research shows that L&R's process is producing a superior outcome for the trust, then the method for the execution should be less important.
And
right?
Auction.com factors into that.
And Auction.com is one of the arrows in the quiver. So while we did sell some $5 billion, that was just north of a quarter of all the resolution strategies that we executed on last year. So a lot of other ways we're selling assets and resolving assets.
I want to make sure the crowd has a moment to ask some questions. I know there are microphones here down at the end of each aisle. Does anybody have questions for our panel?
No questions from my children or my wife, okay? So none of that.
All right, why don't I throw out one more question, and if anybody else comes up with a question after that, great, but if not, we'll wrap it up. Where are the potential shocks to the real estate industry today? What possibly could happen that puts a lot more risk into this thing, creates a lot more distress? What worries you guys at night?
Steve?
Well, I think that there's a lot more event risk and connectivity in the world now than there used to be. The owner of a shopping center asset in the Midwest that might be worth $2 or $3 million and is looking to get a non-recourse loan from a securitization shop. His ability to get that loan on acceptable terms, may be dictated in terms by what happens with the European debt crisis. So you may think he has a local asset and it's a local market decision, but it's really not. And so there's much greater sort of lightning bolt from the sky risk now than there used to be. It's very difficult to underwrite those risks into the market. So you always have to be cognizant that spreads could blow out and things could change very quickly through no sort of traditional reason, nothing fundamental to the U.S. economy. So I think people are more cautious as a result, especially in the CMBS market. Hold periods are very short, and people are concerned. I think the other thing that is important, and it relates to the CMBS market in particular, is that that everybody has sort of a moral compass who's in the business, and that certainly went awry in the peak of the market last time in 2006 and 2007. People were shamelessly putting deals into CMBS transactions that shouldn't have gone. They were underwriting increases in rent and cash flow that had no real chance of occurring. And so it's really important that the market maintain its discipline and maintain some credibility, because I think that investors have been slow to return to the CMBS market because they're so badly stung by the last go round. There's $80 billion of loans in special servicing from 06 and 07, and the insurance companies who bought CMBS and had them in their portfolios on a mark-to-market basis, they haven't forgotten. And so the insurance companies now aren't buying CMBS like they did before, and instead, there's hedge funds and more transitional buyers who are buying CMBS because the spreads are a little bit wider than in ABS or in other adjacent asset classes. If that relationship changes, the liquidity can leave the system, and CMBS pricing can change very significantly over a short period of time. So it's just a lot more volatility. That's sort of the big difference today. And you just have to think about risk factors that I think weren't considered very seriously in the last cycle.
Toby, what?
I think we touched on it a little bit earlier. I'm fearful of the risk transfer model, right? I still think that could lead to a lack of discipline in the credit markets that will cause real pain because in the risk transfer model, you have a loan originator who is paid the day he sells it to the BP buyer, right? So he's made his profit, and that happens in 120 days, right? Then the BP buyer might be making an investment to buy the last 5, 6, 7% of the capital structure at 30 cents on the dollar. So that BP buyer is looking at the investment and saying, okay, the coupon is 5%, right? And if I buy that for 25 cents on the dollar, I'm going to get current coupon of 20%, right? That pays for 5 years. I got all my money back, right? If I get all my money back in 5 years on a 10-year loan, I just bought an option, right, on that pool, right? And so all of the investors in the pool then are buying a loan that pays back in 10 years, right? And so I think that the misalignment in the risk transfer model still exists, and I think that until we address that, we will be subject to inflated valuations for assets because of cheap debt, right? So that bothers me. I tell you the second thing, and we touched on it as well, is the idea that we need some discipline in the regulatory authorities around the mark-to-market issues in the commercial real estate in banks, right? If a bank holds an asset at LIBOR plus 200 today, and it is currently paid to date, made all of its payments, okay? Even if it is only covering its debt service coverage one time, meaning the amount of cash flow from the asset is sufficient to pay its debt, right? All of its expenses and then its debt one time, right? That asset has excess cash flow of 2%, right? That means that asset is trading at 50 times earnings, or a 2 cap, right? And that asset is held at par on the bank's balance sheet, right? I'm scared of that, right? I'm scared of the day that either there's a small hiccup in cash flows, right? Or the regulatory authorities come along and say, listen, you're lying.
Yeah, it doesn't
right?
make sense. Yeah.
You're lying. That real estate asset shouldn't trade at 50 times cash flow. That asset should trade at a 6 cap or,
Definitely
15 times
you definitely
cash
have to
flow.
hope that there's correlation between the recovery of the economy and the inevitable rise in interest rates. Because especially on the floating rate loans, that tends to be what we're more involved with. Having 25 basis point LIBOR, having the peak of the market loans have an interest rate today of maybe 1.5 or 2%, is the only reason why those loans made it to maturity. Why the 06 loans made it to 2011, why the 07 loans are making it to 2012. And what we're trying to do is, if they get to 2014 or 15 with an extension and with some recap, and if rates stay low, you can pay down enough debt to get the whole thing repaid. But if there's a non-correlated increase in interest rates, not correlated with the recovery in real estate fundamentals, then things will be a lot uglier now.
Then it gets a lot scarier.
Like a wild lack of discipline around spending, that might scare you.
Great. All right. Well, let me thank Toby and Steve for joining us today. And I think do we have a question? I'm sorry. I can hear you, and I can repeat the question, or if you want to use the microphone, the audience can hear you.
Well, there's a lot of capital from China. They want to come to the United States buy real estate. And, this injection they don't really want to say, tomorrow get all the money back. They have a lot of capital want to move from China to here. Do you have any suggestions related to your topic?
Well, I will say this, that I'd say probably top of the agenda for the real estate roundtable and for the ULI and for the Mortgage Bankers Association has been something called FIRPTA. And FIRPTA is help me, Steve, Foreign
Investors,
Real Property Tax Act.
Real Property Tax Act, thank you. So the Foreign Investor Real Property Tax Act causes it to be economically almost, unrealistic for foreign capital to invest in fee ownership of assets in the United States, right? We think that's tragic, right? That there's some sort of nationalist behavior going on around allowing foreign capital to invest in commercial real estate when foreign capital can invest in almost any other asset class in the United States, right? I don't know what it is that some nationalistic behavior happened along the way, and FIRPTA got implemented, but getting rid of FIRPTA is critical to allow foreign capital and Chinese foreign capital to come into the United States to help support asset values, right? So, I can say that is one area that the industry groups like the Roundtable and the ULI are keenly focused on and lobbying here in Washington to try to get removed so that we can attract more foreign capital, including Chinese capital.
Well,
Steve, you got anything to add?
Yeah, my recommendation would be invest in debt, and that way you're not subject to FIRPTA.
Right.
You can invest in debt with us. We would, yeah. Well, we've seen Bank of China be very active in the market in major cities with very, very large loans, much larger loans than the U.S. banks are willing to make, and loans that they're holding in their portfolios. And we've seen China Investment Corp being very large investors in some of the opportunistic funds, but again, constrained by FIRPTA. And so we haven't seen a widespread distribution of Chinese money coming into the market yet. But hopefully, if FIRPTA is repealed and there's a greater effort, there'll be more of that capital will find its way here.
I was at a conference the other day, and a guy was telling me, I was just in China, and I was sitting with an investor, and he says, do you like the restaurant? And the Chinese gentleman said, yeah, I like the restaurant. He says, good, I own it. And then the Chinese gentleman said, do you like the building? The guy says, yeah, I like the building. And the Chinese gentleman says, well, I own it. Right? And then he said, do you like America? I own that too.
Any other questions from our audience?
Thank you.
Well, thank Toby, Steve, thank you. Bob, I'll turn it over to you.